I just discovered the main reason Ethereum's price was so bad in 2024 and why it might make a great investment choice in 2025. Hi, I'm Marconi White, a former bank consultant turned crypto investor since 2017, and I've published 10,000 hours of content on how to make smarter investments in the digital asset space. And in today's video, I'm going to explain how the successful launch of the DeFi protocol Ethena is actually suppressing ETH's price and is setting up Ethereum for a potential supply shock in the near future and could lead to Ethereum rocketing higher in a matter of months. And stick around to the very end for a data point that I think makes the ETH supply shock seem even more likely. So whether you own Ethereum or not, as a digital asset retail investor, you want to understand what's driving price trends for the major assets. Because at the end of the day, you really want to allocate your capital effectively to achieve returns that beat the market while managing this risk. And really, there's only three ways to do that. You can be first, be smarter, or cheat. And obviously, I don't recommend cheating. And with the rise of AI, I think it's going to be really, really difficult to be the smartest person in the room. But I still think there's an opportunity to be first, the first to catch where the market has mispriced an asset because it misunderstands the flow or the catalyst driving that price in one direction or another. And yes, AI is going to completely change how we look and operate within these markets. But as long as there's still a human element that can feel emotional about what's happening and eventually FOMO into some kind of asset because they're underallocated, you're still going to continue to see these bubbles and you can still see these shocks. So when it appears that Ethereum, a tier one assets price, might be heavily influenced by a DeFi protocol operating a little bit differently than what you'd expect to see, and it's creating the potential for a supply shock, that may be one of the best opportunities of 2025 to get ahead of the curve. And then you can ask yourself, how do I want to allocate towards that? Which then leads to the next part. You're thinking, okay, Marconi, great, I'm there with you, but something seems off. DeFi was a major boom for Ethereum in 2020, causing the price to skyrocket. Why would a successful DeFi protocol cause ETH's price to stall instead of going up? And your working model is correct. In 2020, people were willing to spend Ethereum and gas fees to access protocols like Aave and Compound and Maker, which reduced circulating supply for Ethereum, adding buying pressure while dampening sell pressure. So why does Ethena, which like other protocols offers a yield in return for staking for its products, cause the price to go down rather than go up? And this is where things get really interesting. Ben Lilly, managing partner and head of research at JLabs Digital, who's written literally thousands of articles on crypto, explained to me on a recent episode of The Trading Pit, it all comes down to how Ethena generates its yield that's creating the sell pressure. Ethena generates yield from two places. The first is staking, and by collecting the funding rate from short selling. And it's the short selling, as you may imagine, that creates continuous sell pressure for Ethereum on the market. And it comes from growing demand from investors looking for yield on their Ethereum. And first, if you're going to understand how this works, you got to understand a little bit about the perpetuals rate market. I'm going to let Ben do that.
Definitely. Yeah. So whenever funding rates get super elevated, and so funding rates is really just in the perpetual futures market, you go ahead and you take a long position. You're going to have to pay for that if the market is sort of neutral. Right? And you're paying the individual on the short side, right? And this is the beauty of perpetual markets. And I know they've existed for a long time, but Arthur Hayes for sure is the one who created all the popularity behind it within crypto. And when you have a ton of individuals taking long positions because it's a bullish environment, that funding rate gets elevated. And what it does is it sort of limits the ability to hold that long position for an extended period of time, because eventually it's going to force individuals to go ahead and close that position. When it gets too expensive to hold a position or kind of open up a new position, right, that's sort of forcing the hand of the market to kind of constrict. And that next unit of capital is now asking itself, is this too expensive? And that's what these funding rates do. And so that kind of helps keep things in check. So in a bull market, those funding rates get really high. They get really elevated. And so what was really popular in 2018 was you could just take a 1x short and you're essentially locking in your portfolio in US dollars.
Mm-hmm.
And because the market was still like hopeful that things were going to come back to life, and because the ICO area was still running hot at the time, is that they were able to harvest yield. And that was incredible. And what Ethena does is essentially does that for you, and it bundles up that kind of 1x short position in its synthetic stablecoin. It's essentially that funding rate getting packaged into an on-chain asset.
So when you deposit collateral to earn yield, Ethena opens a short futures position and is paid the premium from the bulls who are looking for the price to go up. And you can think of it kind of this way. Some bulls are happy to collect a rate of return for holding an asset. These are the ones that are depositing the money into Ethena. And you have some bulls that are happy to pay for the option to speculate on the price going up. These are the ones that are opening long positions in the perpetual market and then funding these short positions. And this means there is consistent sell pressure to hold the long positions, at least in a market where bulls outnumber the bears. So as more investors look to earn yield on Ethereum using Ethena, there's more short pressure that builds into the system. And this actually is helping to keep the price down, keep volatility down. So the first mystery is solved: how the successful adoption of a DeFi protocol like Ethena leads to Ethereum's price volatility being muted. So if you're an investor looking for yield, you can say, great, I like Ethena, but maybe you're an investor that's actually looking for price speculation. Well, if you're interested in price speculation, one of the best ways to be fast and early is to actually be there for a supply shock and see where they're starting to emerge. Okay. What exactly do we mean by supply shock? Well, really, it's quite simple. This isn't really a technical definition, but this is the way I look at it. It's when the amount demanded greatly outweighs the available supply, and you create the conditions for the price to rapidly increase. And one way to determine where a shock could occur is by studying how a token is used and how much of it is illiquid, available for trading. And this, fortunately, is a complete obsession of Ben Lilly, who talks about this all the time on the Trading Pit. So how illiquid is Ethereum because of Ethena usage?
That trade, right? That is not supply that's available that can be traded.
Mm-hmm.
And so if anybody remembers, we call this M2 supply, right? This is not liquid tokens in the market. Same with ETH being locked to Beacon Chain without that liquid staking token derivative off of it. Right? It's not, in order to make it liquid, you have to unstake it. You have to wait a little period, and then you can finally sell it in the market. Right? So it's not fully liquid like a token just sitting in your wallet. Staked ETH, if you hold staked ETH in your wallet, I know it's, there's an underlying unit of ETH being staked, but it's fully liquid. You can sell it tomorrow. Right? So if we ignore Ethena for a moment and we just look at the supply that is moving into this illiquid environment, and that's what this chart is right up here, it's sort of a ratio of M2 to M0 or M0 plus another one called M1. But all you need to know is illiquid versus liquid. When this kind of green and yellow start to climb higher, that means the supply at large, in terms of like a percentage, it's getting more and more illiquid. Right? We can see it has this correlation to price. If things get very illiquid, price is able to respond in this manner where it just goes parabolic. Right? And we don't see this sort of parabolic trend that we saw at the end of 2020. We're seeing a slow march higher. And that's what we see right here. Right? We see a slow march and then bam, price responds.
So Ethena is making more of Ethereum's supply illiquid, removing supply from the tradable stock. And as more long-term investors seek yield, more of the supply becomes illiquid. And if we have a demand catalyst, then a supply shock could ensue. We just need to get the supply shock underway. So what exactly would ignite call it the supply shock bonfire? Rising ETF demand. As been explained, retail that is still in Ethereum from the previous market cycle and perhaps many before that, they're looking for yields. They're more than happy to lock up their Ethereum to get a return of some kind. They're not really worried about selling their assets in the near term. And new buyers, well, if you follow this channel and you listen to us on the Trading Pit, you'll know that retail for spot transactions and on-chain really have not returned to the market, which leaves one new wave of entrants, ETFs.
Any sort of demand catalyst creates these big upside movements. But the only way that we can truly get it is going to be if fresh demand shows up. Because if it happens in this on-chain world, we don't see ETF buyers coming in. We don't see a new class of retail coming in because they're not going to want an asset that's $4,000 per token. So it has to come from somewhere, because if it comes just from within the own on-chain kind of crypto natives, we already know what they're going to do. They're going to go ahead and harvest the yield, put in that 1x short, and we're kind of where we are. Like, we're not going anywhere new. But we're just using ETH essentially as this form of collateral, which is essentially this store of value, if you will, to go ahead and earn this yield. But if the demand shows up from an ETF's side, is fresh demand, it will expose how illiquid ETH has become over the past year and a half.
This is the only vehicle in town that can bring in new funds. Unfortunately for our investors, this is really easy to track and monitor. And if you're feeling at all hesitant to say, well, how much of the ETF is going to go up or down, just ask yourself, how much better will crypto be in a pro-regulatory environment that's pro-crypto? I mean, it's literally the opposite of the last 4 years, and certainly even before that, when pretty much everyone was either laughing or saying they were negative crypto. All eyes are on it, and it looks positive. So we're not done, because the material question still hasn't been asked. Do I want to be long or short if Ethereum rockets higher? Do I want to be positioned with some exposure now, or am I fine sitting on the sidelines if Ethereum goes up 100% or more in just a few months? And it's better to make that choice now than to wait, because it's really difficult to speculate how strong that upward momentum might be. Is it going to be gradual or hyperbolic? And that really comes down to how illiquid is the supply. And before you think about answering that question, I want to give you a little bit of anecdote that I found interesting. When J on-chain launched, its only option was to use Ethereum for deposits and trading. And the first people to really use this product were longtime JLabs digital users, people that have been aware of Ben Lilly's analysis of Ethereum for a very long time. They've been listening to this podcast and a lot of his content, which has been talking about the potential for Ethereum. And their response, the people that were first to use this product, was, hey, can we get Solana? We don't have a lot of Ethereum to use. Now, these are sophisticated investors, and their exposure to Ethereum is near zero. And judging by online sentiment, whether that's X, Reddit, Telegram, wherever, the rest of the market is in a similar situation. And if longtime investors are locked into yield products, sellable supply will be thin, razor thin. It's something to ponder when you're thinking about allocation. But for now, subscribe, like, and be sure to join us live for the Trading Pit. This is Marconi White signing off.